You're watching The Money Show. I'm with you, Kavita Thapliyal, and today is Wednesday, and that calls for a very special show, Women's Wednesday, where we focus on women financial planning and making them better investors. And for someone who hasn't yet started an investment journey, so The Money Show is here with you for your support and our experts' guidance so that you can start working on your investment journey and also achieve the financial freedom goal that a lot of us have actually lined up for ourselves. So let's move on. And today, the highlight of the show is live financial planning. That's right. Just in case you haven't sent across your questions yet, because a lot of women investors regularly send us their queries. So just in case you haven't yet, you can send across your questions on the WhatsApp number that's flashing on the screen. We also have an email ID that will flash on the screen, and you can note it down. Send across your questions, and our expert will be answering your queries and will be guiding you, looking into it that your financial investments are aligned with your financial goals. That's right. Let's move on. And Harshvardhan Roongta, our guest on Women's Wednesday every week, is with us. Harsh, hi, good evening, and welcome to the Money Show. In fact, a very happy New Year to you. And this is our very first Women's Wednesday, in 2026. So let's make it exciting, and let's help our women investors once again towards the right path, in achieving their financial goals. So before I begin with our women viewer queries, I just want to understand the entire sense that you're getting for 2026, in terms of investments. Last year, we saw hybrids and, hybrid funds doing really well, multi-asset allocation funds in demand. This year, how does it look like? More flexi caps in the portfolio. What are the clients asking you?
Well, Kavita, a very happy new year to you, your channel, and all the viewers. I think, this has been one of the events where we're talking about the kind of, outlook that we have for 2026. Now, what happened in 2025? I believe you're going to see more or less the similar kind of reaction from the markets, from precious metals, from okay, just a caution point here. Precious metals were not expecting 70% kind of returns from gold and 150% from silver. But I think the geopolitical situation that we are seeing globally, there's going to be a lot of uncertainty with regards to clarity on how the entire global economic scenario is going to pan out. So I think investors should be very cautious and very mindful of how they deploy their money. We continue to advocate that you should have larger allocations towards the large cap segment, have probably a 30% towards mid caps. Avoid small caps if possible. And if you really wish to enter into small caps, then you must enter through either a flexi cap or a multi cap strategy. Avoid a pure small cap fund because the valuations still seem to be above their logical levels. There could be some kind of pain coming in the year 2026 as well. Another point of caution that I would like to give is that the kind of stellar returns that investors have experienced in precious metals, that is gold and silver particularly, I mean, do not get carried away and do not increase your allocation over in gold and silver only because in 2025 the returns have been extraordinarily good. Because it is very difficult for the same kind of returns to be, replicating in 2026. If it were to happen, if at all, and it will be a one-off case, and it is not something that you should be estimating to happen. So I think just keep your heads down. Do not get carried away with what happened in the past. Stick to your asset allocation. Stick to your basic strategy. Understand your risk profile and then create a portfolio. I think that's the only word of caution. Do not look in the rear view mirror and try and estimate that that's exactly what is going to happen in the future.
Right. With that, let's move on, and let's take our first women investor query, Harsh. And this is from Selja Anand, and she's given her fund mix to us. She has SBI Contra doing an SIP of 5,000 in all of these 5 mutual funds, and SBI Contra Parag Parikh Flexi Cap. She's got Kotak Multi Cap, Motilal Oswal Large and Mid Cap, HDFC Mid Cap, and she's a new investor, and she's been investing since last year Jan, and her target is 1 CR. Portfolio value so far is almost 4 lakhs, and in 12 years she wants to know what's the corpus that she'll be able to accumulate, although her goal is 1 CR, and she will also be stepping up her investment by 10% every year. So the fund mix is what she wants a recommendation and advice on. So your take.
So, well, Kavita, if you just look at her investment and the schemes that she has, the allocation she's made, All the schemes in her portfolio are very nice. The allocations that she's made is also good. So basically, all her schemes that she's investing into represent the entire market segment. So she's taking exposure to the entire market, be it large, mid, small. Her allocations are also good, so she's not going overboard into any one category. If you look at the approach, which is that I'm going to do a 10% step up. So I think that is again good. She has a long-term view, which is 12 years. So I think all the ingredients of a good investment plan are already present. So she should very well stick to it, continue investing the way she is. The good news is also she has a target of 1 crore in 12 years. So if we were to assume a 12% return on the investments that she's making right now, this would grow by itself, only the SIP amount I'm talking about. This by itself will grow to about 1.25 crores. She's looking at a 1 crore investor corpus, but 12% return on her only SIP portfolio, the fresh SIP I'm talking about, will make it 1.25 crores in any ways. So I think everything is good right now. Don't fidget around when not necessarily. Everything seems fine for now. Stick to this plan, stick to the asset allocation, stick to your schemes, review them once in every year. And I think you're good to go. You should be well achieving your target in 12 years.
All right, so thumbs up over there as far as your fund mix is concerned. Just stay put, have a disciplined approach, and definitely you're on the right track with the right fundamentals, stepping it up. And 1 CR is your goal, but one might just want to review other financial goals also, just in case you have, or if at all you have other investments. Taking care of those goals, it's really good. But if you want to go beyond this particular financial goal, then you will have to look at a different strategy, and or maybe just increase your investment amount. Harsh, let's move on. Let's take Nikita Pandey's question. She's from Bihar, Patna. She says she's a government teacher. She's 50 years old, and she wants to plan a retirement corpus of almost 2 CR. She's retiring in next 10 years. 60 is what the age is for her, and she can invest 40,000 per month. And she wants to start investing in mutual funds via SIP, and she also wants you to suggest funds that invest in gold. So interesting. Thank you so much, Ms. Pandey. You have sent across your question. And one thing that I really want to ask you first, Harsh, has she missed the bus as far as retirement goal is concerned? Because she's starting at 50.
So yes, most certainly, I would say that the ideal time to start for planning for retirement is when you get your first salary. So it sounds a little bit outrageous, but that's the fact because the moment you get your first salary and you're in 20, say for example, the lesser amount that you get, you need to invest a very less amount of money to achieve the same target which a person starting at 50 would need to do. And the journey will be very smooth. So obviously, the first step is that the moment you get your first salary, start thinking of the day when you will be quitting work and start planning for it. And it will be the journey will become very easy for you, for your own self. So that this is what you're doing for your own good. Nevertheless, having said this, it's better to think about it at 50 than to think about it at 59, right? So the moment you realize about it, I think that's still good. Yes, ideal situation would have been that you think about it much earlier so that investment amount could be lesser and you would achieve your target. I'll tell you what is going to happen in her case. Now she is planning to invest 40,000 a month for 10 years and she needs about 2 crores. Now, if I were to design a very aggressive portfolio for her, because her target is also very aggressive, she cannot now afford to go conservative, though at her age, there could be a combination of debt and equity. But considering that her target is very aggressive, she would hypothetically invest the entire amount, say in equity funds, which would generate about 12%. Still, she achieves only 92 lakhs against her requirement of 2 crores. So this is where the problem is that the later you start, even if you go aggressive, it's not necessarily possible that you may achieve your target. So in her case, we would design a portfolio which is 100% equity for a simple reason that she has a very aggressive target. So she will need to have an aggressive portfolio. Whether or not she's comfortable with it or not, we're not able to speak to her, but she can obviously will use her judgment on that part. So the 40,000 that she wants to invest, I'll suggest the following schemes. Now, HDFC BSC Sensex Index Fund, that 20,000 she invests over there. Nippon India Multi-Cap 10,000 and ICICI Pru Value Fund another 10,000. So 40,000 rupees giving into three schemes. Essentially, within the equity category, I'm suggesting that she goes into large caps, has a mid and small cap exposure through a multi-cap fund, and have a value-oriented fund. So I think this is the best mix that I could give to her, where she has aggression in her portfolio, the equity growth prospects, At the same time, she plays within the equity space. She's a little more conservative in that context. So I think this is the option that I could suggest to her. And of course, being an actively managed fund, I would suggest she reviews this portfolio every 1 year and takes any corrective steps in case she's uncomfortable with the volatility that is there or she has any other views.
Right, that's the right approach for her. And also, I think a major part of her monthly income, since she's a government teacher, I'm assuming she's be having sufficient pension in hand, So at least day-to-day expenses are taken care of. But then, Ms. Pandey, congratulations. As I said earlier, you took the right step towards a very important financial goal, but then you might as well just want to review it and, analyze, because retirement planning in 10 years can be really tricky. Of course, Harsh has given you the right kind of funds and a way to invest in it, but then you need to analyze your financial liabilities and responsibilities if beyond 60 as well. Then, there will be a need of a change in your strategy. So you can write us back, and, we are happy to help you once again. Harsh, let's move on. Let's take Sushma Shah's question. She says she's from Mumbai, age 34. Her portfolio has HDFC Flexi Cap. She's investing 25,000 per month. Edelweiss Mid Cap 15,000 per month. ICICI Pru India Opportunity 15,000 per month. ICICI Asset Allocator Fund of Fund Lump Sum investment out there 5 lakhs. ABSL Consumption Fund 25,000. ABSL Digital Fund 25,000. Total SIP is 1,05,000 going on. Step up can be done by 10%. And portfolio invested is 32 lakhs. The value is 39 lakhs so far. Goal is 3 CR in 15 years. Is the allocation correct? And she wants to add a small cap in her portfolio. And she also wants to make a portfolio for her parents who are retired. So for that also she needs recommendation. I'm assuming this is a portfolio for them maybe. But yeah, if a separate portfolio is to be made for them, then we need more details. But having said that, a good asset allocation, diversification in her portfolio, except for the consumption fund, digital fund, but also looking at the time, I think right addition, even if it is sector specific. Harsh.
So yes, Kavita, I do notice that her portfolio has a large allocation towards thematic and sector funds. Now, if she's very consciously taken that decision and she wants to continue with the allocation in the sector and thematic funds, I think she can continue. Just one suggestion, in the technology sector, she should invest into the SBI Technology Opportunities Fund in place of the ABSL Digital India. So that's only the one change that I'm making in the sector fund that she has. The lump sum that she has in the ICICI Pru Dynamic Asset Allocation Fund, I think it's fine because it's a good fund with adequate allocations to the equity debt. So I think that she can continue as it is. The other schemes that she has are also fine. She can continue, though there is a thematic fund in that as well. Now, so the scheme wise is fine. Now, I only have a concern on the allocations. 50% of her monthly SIP is going into the thematic and sector fund alone. Now, that draws a little bit of a concern to me because you may want to take an exposure into the digital sector or the technology sector for that matter, or the consumption theory. Uh, but the allocation should be restricted to about 20% of the entire portfolio. That is my view. So I'm again giving a caveat here. If my suggestion is to be taken, I would suggest that she reduces that exposure to 20% from the current 50%. However, having said this, if she's comfortable with what she is doing, then she may continue. I don't have a problem with that. Just that she should be mindful that you're looking at a very, very aggressive portfolio in this case. She understands the technology sector and the consumption baskets, then it's fine. If not, you still want an exposure, reduce it to 20% in total. So 10% in each. Now, rest of the investment that she has is a diversified mandate, so there's no issue on that. She wants a small cap allocation where she could add because she feels that she wants to take additional exposure into aggressive scheme, a small cap sector. Fine. She could go in for the Nippon India Small Cap Fund. So in this context, I've only made 2 or 3 suggestions. One, the schemes are good. One, tech sector fund I've suggested an alternative. Schemes are fine. Otherwise, allocation should be reduced in the thematic and sector funds to 20%. And the balance now she can go into the diversified funds that she has. So HDFC Flexi Cap she has an Edelweiss Mid Cap and the ICICI Dynamic Asset Allocation Fund. With regards to our parents' portfolio, you've correctly mentioned that the information that is provided, I mean, we don't literally have any information as to what they require post their retirement. And retirement being a very important milestone, it's important that they understand what they're investing into. They discuss their cash flows, they discuss their risk appetite, and accordingly they make an investment. So I would recommend that her parents and along with her may meet with an advisor, discuss all those details in full nuances, understand all the nuances, and then invest. Do not just make one line statement saying, "Want an investment suggestion for my parents? Please suggest." I think it could be extremely dangerous for a category of people who are especially retired.
Harsh, one question specifically on one fund. ICICI Pru Asset Allocator Fund of Fund. This has been in buzz in news also. A lot of investors have latched on to it, and also because it's a asset allocator fund of fund, and dynamic funds and multi-asset category has been really doing well. Right time to put money into this, or we have missed the bus over there, or you think if it's a long-term horizon, you get exposure to different asset classes, and this is the time. It is a must-have. What's your take?
So, see, Kavita, if you observe investor behavior, investors usually get carried away with past returns. So, what happens is now, if you started your investment journey with, say, a 50% in equities, 30% in debt, and 20% in precious metals. Now, if that is your asset allocation, now you started the year 2025 with this allocation. Now, if you see the end of 2025, precious metals at 20% allocation is almost doubled, right? So your overall portfolio, equity hasn't done anything. So 50% allocation probably is at 50%. Debt has given you about 7% kind of return. So 30% is generated 7%. 20% precious metals is almost double. Now, if you were going to sit and look at your asset allocation, your equity allocation has come down from 50%. Debt has been almost there probably, and precious metals allocation was as a portion of your total portfolio has gone up. Now, how many people at this stage would have that kind of prudence where they will reallocate everything, which means that they will sell precious metals, they will sell some part of debt and invest more in equity. Now, not many investors on their own are able to do this very prudently. This is where you will find where asset allocation funds or you will find the multi-asset funds doing this on behalf of the investors without any emotional biases. So that is the reason we suggest that if somebody wants to get away and do away with that emotional bias of selling something which is going up continuously, investing into an asset which has not been doing well, requires a lot of mature mind and prudence. So this is if you cannot do it on your own, allocate the money into an asset allocation kind of fund where this rebalancing happens on its own. So yes, I think it's a good product to have in an investor's portfolio. It takes away all the headache of rebalancing and emotional biases away from investors.
All right, perfect. So that's the take if one wants to have a multi-asset category in their portfolio. But then let's move on. And Harsh, this question is from Sakshi Sisodia, and she's from Kolkata. She's 36 years old. She wants you to review her portfolio. Portfolio value is 1.45 lakh. She's an aggressive investor, 1 CR in 10 years for her daughter education. Bandhan small cap 7,000, Bandhan Motilal Oswal mid cap 5,000, Parag Parikh flexi cap 5,000, Kotak multi-cap 5,000. She wants to increase SIP to 35,000 and best fund for higher returns. That's the goal that she's aiming for. So Sakshi, very important goal, child education, and looking at the rupee depreciation, you might want to have a buffer for that also. Harsh, how can we go ahead? And also, I'm just wondering, she's an aggressive investor, full-on equity approach would be really good. But having said that, something like a Sukanya Samriddhi can also be considered as an addition because it's a daughter education goal.
So, well, Kavita, first I'd like to just make some observation on her approach saying, give me the best fund with high returns. Okay, and she also mentioned that I'm an aggressive investor. So, Sakshi, just one piece of advice that, you know, taking more risk in an investment does not necessarily translate into higher returns. You have to equate the risk reward ratio along with the volatility that comes along with each investment types. So it has to be a very prudent, combination of volatility, high risk, which actually should translate into high returns. So in very simple words, there is a calculated, a measure of difference between adventure sports and committing suicide, right? So it doesn't mean that every time you jump off a cliff, it is going to give thrill. It does not necessarily mean that if you do not have sufficient safeguards and you've not taken the correct preparations. So addressing that thing of for investors saying that I'd like to take more risk because I'm very aggressive does not mean it translate into good returns. So your approach should be, your aim should be that I get a good return with the kind of risk that I'm going to take. Now, having said this, if I look at your investments, which is you're saying up, you're going to up it to about 35,000 a month. Over 10 years, if I assume a 12% return, the amount that you're likely to accumulate would be approximately 80 lakhs. Now, you require 1 crore, but I think it's a fair ask at this juncture to start your investments with this much, try and reach 80 lakhs, and 20 lakhs, you can always look at education loan or something. Now, if I were to suggest some changes that you would need to make uh, for the additional amount from 22,000 to 35,000 and keeping your schemes same, I'm only reallocating the amounts differently. So just pay attention to that part. Bandhan small cap, you're currently investing 7,000. Continue investing if you wish to have that allocation towards small cap, continue as it is. Motilal Oswal mid cap fund, increase your SIP by 3,000 to 8,000 rupees there. Parag Parikh Flexi Cap, increase it by 5,000 and make it total 10,000. Kotak Multi Cap, make it 10,000 again. So your additional investments that you're going, barring the small cap, I'm increasing it into all other schemes. Now, given your aggressive profile, given your expectation, I think this is a fair portfolio which will hopefully give you a good return. uh, I don't know what your definition would be, but I think assuming a 12%, which is AMFI guidelines, assume a 12%, you should be at about 80 lakhs. And if everything goes better than this, then all you know, you may be at 1 crore, which you're targeting.
Important highlights to be noted, and these are the basic rules with which you should be going ahead and taking each step in your investment journey. Last question for today's show, and this is from Rupa Shah. She's 47. Time horizon of investment is 7 years and more. Already has 20 lakh in mutual funds, doing an SIP of 45,000 per month, and 20 lakh in lump sum investment she wants to put now. Right now, she's doing an SIP in Access Small Cap, HDFC Mid Cap, ICICI Nifty 50 Index Fund, Parag Parikh Flexi Cap, SBI Balance Advantage. Lately started with Bandhan Small Cap as well. DSP Nifty Small Cap 250, Quality 50 Index also she has in the portfolio. So interesting, Rupa. Interesting, Rupa. And okay, so she's got a couple of repetitive mix in her portfolio. So, in one category, there's a lot of concentration. How should she segregate this?
So interesting part is that she's looking to make a 20 lakh lump sum investments. I think this is one of the queries that we received recently, only recently now, that somebody has talked about 20 lakhs to be invested as lump sum after having experienced what they have done over the last 1 year. So I'm encouraged, I'm happy, and that she has the faith in the markets and she wants to go ahead doing that. Now, the fresh investments that she wishes to do, I mean, I'll pick the existing schemes that she has because she doesn't need to add any more schemes. So Parag Parikh Flexi Cap, you could put 5 lakhs. ICICI Nifty 50 Index Fund 5 lakhs. SBI Balance Fund, though now it has been, she mentioned it as Balance Fund, but it is changed to SBI Equity Hybrid Fund. She puts about 7 lakhs there. And HDFC Mid Cap Fund puts 3 lakhs. So I think the additional 20 lakhs that she wants to put will get deployed and it will be ideally a large cap oriented with some allocation to mid cap and one equity hybrid fund. So I think that's what she could look at. Expect volatility in the market, be prepared for suboptimal kind of returns, but do not give up because over long term the Indian economy looks very, very strong. And eventually, I am hopeful that you should be able to get a cumulative kind of or a compounded kind of a return of about 12% annualized over the next 7 years. So you should be very, very, possible. It would be possible for you to reach your goals that you're attending to. So my good luck, my best wishes to you.
All right. So that's the recommendation coming in for Rupa. And with that, it's a wrap on the show as well. Thank you so much, Harsh, for taking your time out and helping our women viewers and investors navigate their investments on the financial journey today. Thank you so much. And before I sign off, for all the women viewers and investors, you can send across your questions. Every Wednesday, we get this Women's Wednesday special program to you. You can either WhatsApp us your queries or you can also email us your questions. Do give us the details of your current investments if you have any, or if you haven't yet started taking the first step. We are here to guide you. Thank you so much for watching. Goodbye.